You're paying too much in investment fees. Really, you are. The only way you're not paying too much in fees is if you're not investing at all. That's a whole other problem. I wish you all the best, and I hope you get the help you need. I don't need to be a psychic to know you're paying too much to invest because we all are. Even the low fee loving Vanguard boggleheads out there are paying too much. Some of you might think I'm making a mountain out of a molehill. Most people don't realize they are paying any financial fees at all, let alone see it as a problem to solve. Many don't understand how much tiny percentages can add up over longer periods of time, how they can act as an anchor that slowly turns your Queen Mary into a Titanic. So, what's wrong with financial fees? If you are paying what you consider to be low fees, why is that such a problem? The term low fees is subjective and can be misleading. I would argue any fee is too high. Financial institutions should be paying you for access to your money, not the other way around. Studies have found that up to 25% of your investment gains can be lost to financial fees of just 1%. For a mid-tier millionaire, this can literally mean over $1 million lost to financial fees. Even with more modest fees, it's shocking how much they can eat away at your returns over decades. Even if you are diligent about investing in low cost investments and the fees are only 1/10 of 1%, would you rather have another 100,000 in your lifetime, or do you prefer to donate it to Wall Street? Junior does need a new sailboat. Before you do zero fee investing, you need to understand where you are paying fees and how much it'll cost you. The cost of financial fees is not only the money you pay each year, but the money you could have made, the growth you would have realized projected over your investment horizon. We know that interest compounds, but so do investment fees. Let's start by taking a look at what financial fees you are paying today. Most people in the United States are not paying fees to trade stocks anymore, but it was not very long ago that retail investors had to pay a punitive stock commission fee on every trade they made. These commissions could easily cost $5 to $25 depending on where you traded. Trades with fees under $10 were often considered low fee trading and offered by discount brokerages. If you are still with a brokerage that's charging you to buy or sell stock, you need to stop. This is your own damn fault and there are no excuses. Switch to a no-fee brokerage. If you have a financial advisor, you're likely paying fees. If you insist on outsourcing one of the most important things in your life to somebody else, please at least ensure they are a fiduciary advisor. Regardless of what type of advisor you have, it's important for you to understand how much you're paying in fees to this person. Convert it into an annual dollar amount and ask yourself if the value they add is worth the money you're paying. Some financial advisors don't charge any advisory fees. They instead make their money from commissions or fees attached to the financial products you're putting your money into. If you live in the United States and are paying 1% for an ETF or mutual fund, in my humble opinion, you're being ripped off. Run away. If you're paying a percentage on your investments for advisory fees, running away is not enough. Take the fees you are paying and hire Usain Bolt to piggyback you to safety. Ask him if his financial advisor was worth the fees. What about low fee ETFs and mutual funds? Low fee ETFs have been the best option available to investors for a long time. And if that has been your investment strategy, you've been doing the right thing. Give yourself a pat on the back. The fees on ETFs can range from very small to very high. It's always important to know what the expense ratio on an ETF is before investing. As a general rule of thumb, the more trendy or actively managed an ETF is, the higher its fees will be. You will find the lowest fees on ETFs that track an index like the S&P 500. Vanguard's one of the leaders in low-fee investing. The first investments I made in the United States were done on the Vanguard platform. I was, and to some extent still am, a big fan of Vanguard and their approach to investing. They were true pioneers in low-fee ETF investing, and the low-fee and no-fee options available today would not exist without Vanguard's iconic S&P 500 ETF, VOO, which has an incredibly low expense ratio of only 0.03%. If you insist on paying financial fees, this is the gold standard. With the VOO ETF, you can pay practically nothing in investment fees. The Vanguard fund is still one of the best choices for brokerage accounts, but for tax shelters accounts, I'm still not satisfied. 0.03% is still 0.03% too much. I don't want to pay anything in financial fees. When you are auditing what you are paying in an ETF and mutual fund fees, don't forget about other financial accounts like 401ks, IRAs, and HSAs. Although the investment options offered in these can sometimes be limited, it's important to choose the funds that will minimize your expense or move what you can of these investments to a provider that will give you more low fee or no fee options. One other little known financial fee can come from buying and holding stock. While buying stock is generally an excellent way to invest without paying any fees, when you buy shares in a company located outside your country, you are almost certainly paying additional fees. These are known as over the counter or OTC securities. Any stock that is not listed on a major exchange in your country is instead traded OTC via broker-dealer network. While many brokerages include this in their zero-fee trades, some brokerage accounts do charge for OTC transactions. Even if you don't pay to trade OTC, you can still be subject to currency exchange fees, maintenance fees, and dividend withholding taxes. I'm not saying this is a bad thing. I personally own OTC shares in multiple companies, and it can be a great way to invest in international stocks. But it is important to be aware of the fees you're paying and determine if OTC shares are necessary for your investing strategy. Unless there's a foreign company that you're particularly in love with, my advice would be to invest mainly at home to avoid additional taxes, currency, and trading fees, assuming you live in a stable country with decent economic prospects. I believe the saying that fits here is do what I say, not what I do. The last type of investment fees I want to talk about are taxes. Although they are not necessarily a financial fee, they are the biggest fee you will pay when exiting a profitable investment. It is important to understand the difference between long-term and short-term capital gains taxes. When you hold a stock for less than a year, any profits you make are short-term capital gains. These are taxed as ordinary income at your marginal tax rate. In the United States, this could be as high as 37% plus whatever your state income tax is. Stocks held for over 1 year are eligible for more favorable long-term capital gains tax, which varies depending on your income level but is typically 15%. While some people are successful day trading, statistically you're not going to be one of them. Although you may need to exit an investment for good reason before a year has passed, try and make quality long-term investments to minimize the taxes you owe. I hope this video opened your eyes to the many ways you can be paying financial fees. If you don't know how much you're paying, I recommend figuring out what the expense ratio is on your investments and putting a real dollar figure to it based on your previous year's investments. It's shocking to most people how much they pay in a single year for financial fees. To really illustrate the point, calculate what the return on that money would have been in a year and then extrapolate it out over 40 years or whatever your remaining investment horizon is. Scary stuff.